The top stories live from the Sky News City studio. The Bank of England set to raise interest rates today for the 13th consecutive time, more pain for borrowers. Why challenging economic conditions are causing the construction industry to struggle. The Treasury says post-Brexit reforms to the insurance sector will start by the end of the year, unlocking £100 billion worth of capital.
In the late 60s, radio had hardly any Australian content. I couldn't understand why people weren't supporting their own more. That's why Mushroom started.
Plus 50 years of making noise. I'll be joined by the Chief Executive of Australia's legendary music company, Mushroom Group. Good morning, this is Ian King Live, an hour of business and economic news from the heart of the city. Borrowers are bracing themselves for a 13th consecutive interest rate rise today from the Bank of England. That will be this lunchtime. A rise of 0.25% to 4.75% was expected at the beginning of the week. But yesterday's inflation numbers suggest a half percentage point rise to 5% could be possible. Well, there are fears that higher interest rates could push the UK towards a recession, something that the Chancellor Jeremy Hunt has said he'd be comfortable with if it helps to bring down inflation. But this morning, the Foreign Secretary, James Cleverly, told Sky News that wasn't the opinion of the government.
We need to grow the economy. High interest rates don't help with that. This idea that that we should consciously be going into a recession, I don't think is one that anyone in government would be comfortable subscribing to at all. What we want to do is we want to drive productivity. This is why the Prime Minister is taking both the immediate measures and also the long-term measures, his commitment to maths, lifelong learning, higher skilled workforce. These things will increase productivity. That will help grow the economy. That will help halve interest rates as we have committed to do.
Joining me now, Sanjay Raja, Chief UK Economist for Deutsche Bank Research. Sanjay, good to see you this morning. You're expecting a quarter-point rise and a 7-2 vote. You don't think any of the MPC will go for the full half point?
Good morning, Ian. I think there's a very clear risk following yesterday's inflation print, that blockbuster inflation data that we had yesterday, that could tilt the odds for maybe 1 or 2 votes for 50 basis points. Now, we still think that the bank will deliver a quarter-point hike, taking bank rate to 4.75. The markets are pricing in about a third probability that they could surprise with a big hike this morning, or this afternoon rather, and also surprise with bigger hikes over summer and beyond. There's a clear story here, not just about what the Bank of England does at noon today or what it announces, but certainly what it says about the future of interest rates going forward through the summer and beyond. But there is a clear risk. Inflation is persistent, the labour market is too strong for the Bank of England, and it may require a tougher dose of medicine.
Absolutely. I mean, the inflation data, as you say yesterday, very, very disappointing. Has that changed your thinking on where the terminal rate will be, the moment where the bank stops raising rates?
So our base view is 5.25. So we still have multiple hikes to go, but the risks following yesterday's print is certainly to the upside. It goes without saying. So yes, more pain for borrowers, mortgage holders, corporates, firms, businesses, everyday people. But that's the challenge that we face in the UK, to get inflation sustainably back down to target. That's the Bank of England's mandate. It has to get inflation CPI to 2%, and it needs to do whatever it takes. It looks like, given the data that we had last week from the labour market, given the data that we saw yesterday, core inflation up to a 31-year high at just over 7%. Just unsustainable for the MPC to keep things on hold. So it's very, very possible that rates start to converge to market pricing, which is roughly around 6%. Big numbers, big costs, big hit to the economy. And I'm not just talking about households and corporates, but for the government as well.
Sanjay, you touched on wage inflation just now. Clearly, it was very pronounced at 7.6% for the private sector in the latest data. Is it higher prices that are now driving wages higher, or is it wages driving prices higher? It's a sort of chicken and egg situation almost.
It always is when we look at the labour market and wage growth. In the UK, wage growth has always been lagged. It always responds to inflation, particularly near-term inflation expectations. We've had an imbalance between supply and demand for some time coming out of the pandemic. You know about this, the whole big hit to participation, the labour force being shot quite a bit coming out of the pandemic. and demand staying very elevated. We still have over 1 million vacancies in the labor market. Compare that to pre-pandemic, it was just roughly under 800,000. So demand is still there, supply is a bit weaker, recruitment difficulties much more elevated. So wage pressures are certainly very, very high, very elevated. And so what we are seeing are firms, corporates, public sector respond to higher cost of living. So wage growth is reflecting that to some extent, but it's also reflecting this endogenous relationship that actually the labor market here in the UK is extremely tight, and it's showing very few signs of cooling just yet. For the Bank of England, this is a big problem. It needs to see the labor market cool. It needs to see wage growth come down. It needs to see the unemployment rate pick up just a little bit to show that there is slack in the labor market. If this committee is to get confidence, to become confident that it can get inflation back to target. So we're some way away from that equilibrium.
Absolutely. I mean, there's obviously a lot of talk of recession in the air right now. Now, Hugh Pill, the chief economist, gave a speech recently where he talked about the risks of over-tightening. How much of a factor is it going to be in the MPC's thinking, the risk of a recession?
I think that the Bank of England will have to walk that fine line. The medicine that it's administered so far to date is having very little effect. But of course, a good chunk of the rate hikes have yet to pass through. On our estimates, roughly about a third of rate hikes have actually come through into the economy. We know that the housing market is feeling less of the effects of these rate increases given the fixed nature of the mortgage market. So there's plenty of that tightening yet to come through. So walking that fine line is going to be very interesting. But yet, we have yet to see, unlike other economies, inflation, both headline and core inflation, services inflation in particular, start to come off from these record highs or multi-decade highs. And that for the Bank of England that's chasing inflation, trying to see evidence of less persistence in the data, that is worrying. So they have to walk this fine line between over-tightening, the risk of over-tightening, but at the same time, doing very little could risk prolonging this excess inflation battle, which is, I think, one of the biggest challenges that we face for a generation.
You mentioned just now the fact that the full effect of previous rate hikes have not yet been felt in the economy. Andrew Bailey, the governor himself, has said it's only about a third so far. When do you think the full impact starts to get felt?
So really until the end of 2024, early 2025. And this comes back to the point, Ian, that we were talking about, that trade-off, the risk of over-tightening, yet inflation expectations need to be anchored. Persistence of inflation is still there in the CPI, the labor market data. So the bank has to walk this fine line, and there's no clear answer as to where they need to go. We need to see evidence of these price pressures come down. It could result in a quicker policy reversal. So get interest rates higher, but then start to reverse course in the coming months, or as soon as we start to see evidence that those price pressures are easing. But for now, I think the Bank of England has its hands tied. It needs to see those pressures come down, and it looks like they need to do a lot more to get them back sustainably back to target.
Sanjay, we've got to leave it there. Really busy day for you, so we do appreciate you sparing the time to chat to us. Thank you.
Thank you, Ian.
And if you click on the QR code on your screen now, you can read my article explaining why the Prime Minister and Chancellor face a conundrum as interest rates rise with no silver bullet to end the crisis. Have a scan of the QR code for that piece now. Now, while the UK economy has confounded expectations this year by not falling into recession yet, some parts of the economy are suffering a contraction, most notably construction output. And according to an industry forecast published this week, the rest of the year will also be challenging for the construction sector. The consultancy Glenegran expects project starts to drop by 18% this year, with inflation, high taxes and rising mortgage rates expected to constrain activity in consumer-related areas such as private housing, retail and hotels and leisure. Well, joining me now is Alan Mullane. He's Economic Director at Glenegran. Alan, welcome to you. I mean, it isn't all doom and gloom. You think government spending is going to support the sector to an extent?
Yes, I think that's probably one of the sort of good news areas within the construction industry, in the sense that actually last year the government underspent. A lot of money got rolled forward in terms of capital programmes to this year. So areas such as education in particular and health are looking a bit brighter going forward. Obviously, there's other areas that are under pressure, particularly on the private sector side, and that's the bit that's really suffering at the moment.
Just to stay with that point on government spending, it's health where the majority of spending is going to come through.
Health and education. And health at the moment, obviously, there's a bit of a delay and a lag that we anticipate, really because management time really has been directed at sorting out sort of industrial strife and the long sort of waiting lists.
Yeah, you've touched in the report on the changes that have been made to public sector procurement this year. Is that creating extra bureaucracy for the sector to sort of grapple with?
There's a risk of that. There's a lot of change that actually, if the industry can gear up to that, it could actually smooth companies' progress forward, because the idea is really of those changes that it simplifies it. It's a one-stop shop for people to be able to get onto the lists and procure projects, but obviously they've got to be organised in the first place, make sure they're on those procurement programmes to be able to win work.
What were those changes pushed through? What was the reasoning behind it?
I think really was to try and drive forward efficiencies. So that it was done in conjunction with the industry, with the objective of actually trying to simplify the procurement process.
On the brighter side, you think project starts are going to rise by some 12% next year?
Yes, that's good news. And really it's in anticipation of the fact that at the moment, as you say, we're not quite in recession at the moment, but we have got a stalled economic environment during the current year. But as we get through to 24, 25, there's an expectation actually we'll see a return to sort of reasonable growth within the wider economy, and that should give the private sector in particular more confidence to come forward with more projects.
Obviously, the industry has gone through a lot of difficulties in terms of supply chain bottlenecks, a lot of building materials not getting to where they should be on time. Has that started to work its way through now?
I think that is easing now. That was a particular problem last year, but at least we've got a little bit more stability, particularly in terms of material prices. They're high, but at least they're not rising in the way they were previously. So that gives contractors and others a bit more confidence to be able to plan projects more clearly. I think during the current year it's going to be more demand rather than supply that's the constraint on activity.
And what about the labour market? Obviously that is pretty tight.
Yes, that is going to remain an issue. That's going to be perhaps one of the cost pressures that the industry is going to have to deal with over the current year. Obviously there's a shortage of labour, sort of post-pandemic and post-Brexit as well. We used to use a lot of EU labour. So as an industry. So all those issues mean that there's more sort of cost pressures being faced by the industry on the labour supply side. So investment in training and labour retention is going to be a key thing for firms going forward. For
those who aren't in the weeds of the construction industry in the way that you clearly are, how important is private house building as an overall proportion of activity?
It's a very big slice. It's about a quarter of the industry is private housing related. So it's clearly a big engine for construction, but also for the wider economy. And that's one of the areas of particular weakness during the current year. Because we're seeing that the sharp rise in interest rates and the slowdown in the wider housing market, house builders at the moment aren't opening up new sites. They're really concentrating on pressing ahead with the sites that are perhaps already under construction and trying to secure the sales on those.
Yeah, that was one thing that really struck me yesterday with the results we have from Barclay Group. They haven't been adding to their land holdings recently. I mean, that's potentially going to present itself in a slowdown in activity. How far in advance?
There can be quite a long feed-in time for that. It depends on what sort of stage those projects are at in the development process. But it can be a drag on activity over the medium term. And obviously the changes in the planning regulations, for example, again is potential longer-term restriction on land supply and therefore the land that's available for new homes.
In the meantime, I mean, certainly I hear from a lot of CEOs in the commercial property space that tenants want more environmentally friendly buildings and so forth. Is that a big generator of activity, or is that really just sort of repair and maintenance?
I think it's going to be. I think what we've seen over the last year or so, and at the moment, is a lot of refurbishment fit-out work, really because obviously the change to hybrid working means that actually people are trying to repurpose existing space that they've got. But we're also seeing, actually, as you say, that trend towards premium office space. People want to have good quality office space and have high environmental specs, and the regulations are moving in that direction as well. So again, that could generate new opportunities for the industry in terms of repurposing existing buildings, refurbishing them to higher environmental standards, or actually redeveloping that site with a new building that's got the right environmental credentials.
OK, Alan, got to leave it there. Good to see you today. Thank you. Some other business news stories for you now. And the UK is to implement post-Brexit reforms to the insurance sector by the end of the year, the Treasury said this morning. It is hoped that changes to the so-called Solvency II rules, which will govern the sector, will unlock £100 billion worth of capital to be invested across the economy. Well, the Treasury said the reforms would boost economic growth by delivering a more tailored, clearer and simpler regulatory regime and would cement the UK as one of the best countries in the world in which to do business. It said the government was determined to implement reforms as soon as possible, with the legislation in place by the end of the year, with most reforms coming into place by the end of June next year. The owner of the Premier Inn budget hotel chain said this morning it was continuing to benefit from the recovery in travel and tourism. Whitbread said that in the 13 weeks to the 1st of June, Premier Inn enjoyed UK sales of £686.5 million. That was up 15.6% on the same period a year ago. In Germany, where the company has been opening more sites as a proportion of the overall business, sales were up by 115%. Well, Dominic Paul, Whitbread's chief executive, said, "Our business is in great shape and doing well." The FTSE 100 paper and packaging group DS Smith this morning credited cost-saving measures and price increases for a sharp rise in profits despite a decline in cardboard box volumes. The company said destocking by its customers, which include Amazon, and weekend consumer demand had led to a fall in box volumes during the year of some 5.8% on a like-for-like basis. But it more than made up for that with higher selling prices as it passed on higher energy and wages costs to customers. Adjusted operating profits during the year to the end of April came in at £861 million. That was up 35% on the previous year. And Volex, the specialist manufacturer of critical power and data transmission products, is buying Murat Tikaret, a Turkish manufacturer of complex wire harnesses, for €178.1 million. The takeover, first reported by Sky City editor Mark Kleiman last night, is the biggest in the company's 130-year history. Well, Volex, which is based in Basingstoke in Hampshire, is raising £58.5 million from a sale of new shares to help pay for the deal. Shares of the company, which employs more than 8,000 people worldwide, have been slightly lower on that news. Well, later on today, the Bank of England is expected to raise its main policy rate, which will have consequences for both households and businesses alike. Well, among those keeping a close eye on developments will be Nirvana. It's the UK's third largest asset finance provider, in addition to providing personal loans and helping some of the UK's best-known retailers provide credit to consumers. Today, the company, previously known as Hitachi Capital, reported a record pre-tax profit of £60.8 million for the year to the end of March. That was up 24% on the previous 12 months. Well, joining me now, I'm very pleased to say, is Robert Gordon, the Chief Executive. Robert, very nice to see you again. Before we discuss your results, talk to me about the impact that you've been seeing of the bank rate increases thus far.
OK. Yeah, we're not a bank, so we're a finance company and we have to borrow from public markets. So we have seen interest rates rise since December 2021. So we've had that in our vision all the time, seeing that rate rise and our margin squeeze. So it's been a very challenging year for us. I mean, that probably sounds remarkable considering we've had another record year, but it's been very challenging for us to make up that margin squeeze. We're not a bank. We haven't got that stable deposit base, which the banks have had to fund their mortgage books and their lending. So they haven't passed on those increases for a long time. And I think it was only really October last year, that people really saw that interest rates were going up, and now they're seeing it again as it's starting to hurt.
Yeah, I mean, in terms of access to funding for your business, how have you found conditions in the wholesale markets?
It's been tough. I mean, you're trying to get investors to part with their money for 3 to 4 years at a fixed rate, and you want a premium on that if you're an investor, because you're seeing expectations in the market, rates rising. So it's been tough, and our cost of funds have been going up. We're competing with banks whose funds haven't been going up with their stable deposit base, and demand is price elastic, unfortunately. So we haven't been able to raise our prices to our customers as much as our costs have been going up. So there's been a lot of margin squeeze.
Give me an idea of the extent to which your funding costs have risen.
Trade secret. I can't reveal that. But you can see rates have moved below 1% to your 3-year rates are now just the market rates are 4.5, 4.6, 5%. They're very volatile. They move every day.
Yeah. So in terms of the results then, all 5 of your divisions enjoyed growth during the year. Where was growth strongest?
It's been a challenging year. Because of that margin squeeze, we had to take action right at the beginning of the year. So, one of the most important things about our business is we're incredibly diversified. We lend to big business, small business and consumers. So having that diversification, if one part of your business starts to contract a little bit, normally there's another part working well. So we do lots of different products. Operating leasing is one of our prime products. So we actually own the asset. With supply chain difficulties, prices have been going up. So we've made huge gains on, when we're disposing assets at the end of lease, which has been amazing. We also invested in green technology. Oh, I said dream almost, but it was green technology. Being a pioneer in that area, in particularly electric vehicle charging, has been absolutely brilliant for us. We funded the first electric forecourt in the world, and that investment, the investment requirements in that business, that sector, are beyond us. But to actually create that business, to fund it in its early days, and then to see it flourish and new shareholders come in, we made a spectacular gain on that investment too.
Yeah, I mean, Vehicle Solutions obviously growing very rapidly on the back of the electrification story. How quickly does that cycle hit its peak and then start to taper off?
Well, it's got a long way to go. I mean, 20% of our assets are now electric vehicles, which means 80% are still internal combustion engines. And that's going to take a long time. Even by 2030, it's not going to be a huge percentage of vehicles being electrified at the moment. It's taking a long process. So, we're at the forefront. It's not just supplying electric vehicle, the funding on that. It's actually helping provide a depot, helping them vehicle management, helping them understand how the battery works and how the charging process works and what routes you have to take. I mean, I've been driving an electric vehicle for years, and it's not very often that you need, the range is limited, but it's not very often that you need the range of 400 or 500 miles. And we're building the infrastructure to enable that to happen with GridServe to charge them effectively.
What about on the consumer finance side? Are you seeing a rise in delinquencies?
No, I mean, slowly, but I mean, there's another reason why our results are so fantastic, because arrears have been low. Credit quality in the UK is amazing. The UK is a very complex economy because you're seeing such strength and then you're seeing such fragility. So it's really hard. The Bank of England has a very difficult process to actually just make the demand a little bit less to control inflation, and that's very difficult. So hopefully the rate rise today is not too significant. Hopefully it's not the 50, hopefully it's the 25. But we've seen rates go up since December 2021. It's a long process. 13 rate increases over a short period of time. When you look back, it's been so stable for so long, and I've got people in the company who haven't seen rate rises, and that's one of the difficulties that every business has got. New people haven't seen rate rises. They don't know what to do, and it's taking a while for that to feed through. So inflation's taking a while to feed through, and it take a while to control. It's
a fascinating point that you raise there. I mean, trying to get a handle on consumer mentality, on consumer psychology, and for businesses as well who may not have seen this either. You just can't map it. You can't.
No, you can't map it. And we've seen huge demand last year because people are getting in and making those purchases because they're seeing the price go up. So what do? Bang, go and buy now. So that demand has probably been greater than people expected. We saw great new business volumes last year for retailers, etc. And now we're seeing it taper off. So we're seeing things start to cool down. So, do you need to put a massive increase in interest rates to cool the market? It's probably already cooling. We're making decisions. We've been growing our staff, regularly. And this year I'm saying, bang, we'll only replace staff as we get turnover. We're not budgeting on growth, we're budgeting on efficiency, and that's the thing that's missing in the discussion. We have to improve efficiency across the economy to also help meet the demand.
Robert, got to leave it there. Always good to talk to you. Thanks for joining us today.
Thank you very much, Ian.
Just a reminder to you to check out the Ian King Live podcast, which you can find by scanning the QR code on your screen now. It's available now wherever you get your podcasts, including the Sky News app, Apple and Google Podcasts, and Spotify.
Thank you.
Well, Wall Street sold off last night after the Fed's chairman, Jay Powell, hinted at further interest rate rises, and that was followed by declines overnight for equities in the Asia-Pacific region. Stocks in India, which isn't on the screen, briefly hit a record high before selling off later in the session. The Hong Kong Stock Exchange, by the way, you can ignore the figure there in the top right-hand corner. That was actually closed today for the Dragon Boat Festival. Well, in Europe, stocks have been in negative territory for most of the morning. The prospect of further interest rate rises casting a shadow everywhere. Talking points today in continental Europe include Electrolux shares there down some 3% in Stockholm. That is on reports that a Chinese potential buyer has dropped its interest. Well, here in London, the FTSE 100 also in negative territory right now, down nearly 0.9% in a broad-based sell-off. As ever at this time of year, a lot of stocks are trading ex-dividend today. In other words, they're trading for the first time without the rights to the latest payouts. There's an automatic adjustment lower. They include, among today's batch, Experian, United Utilities and 3i. If you own shares in those, don't worry, that's just an automatic adjustment to reflect the fact that they've gone ex-div today. And the gainers, Ocado is ahead by some 18%. Look at that, 42% now. You would think on that basis, they're going to have to put out a stock exchange announcement. That is an enormous jump on the session. There was a broker's note out earlier in the week from JP Morgan Cazenove that speculated about takeover possibilities, and that's been amplified in the Times newspaper today, and that appears to be what's driving the stock price there. But a move like that, you would expect the listing authorities to require Ocado to put out a statement. Among the mid-caps today, well, again, there are lots of ex-dividends weighing on the FTSE mid-250 there. They include British Land and Tate & Lyle, both of those automatically adjusting lower because they've gone ex-div. On the foreign exchange markets, well, the pound sold off yesterday on the back of that awful inflation data amid concerns the Bank of England will have to push the UK into a recession to tame inflation. Not much of a rally, as you can see, overnight there. Sterling more or less unchanged right now against both the US dollar and the euro. Similarly, the single currency, not much change there against the greenback. As for the oil price, well, it rallied yesterday and it's come off a little bit today. A barrel of Brent crude will currently set you back some $76.30 a barrel. That is down just over 1% on the session. Joining me now, Zoe Gillespie, investment manager at RBC Brewin Dolphin. Zoe, good to see you this morning.
Good morning.
Not masses of corporate news to get our teeth into today, but I mean, Whitbread still continuing to hum along nicely.
Yes, and I think we've, as you say, the kind of not a lot of corporate activity, but with Whitbread, I think there's been a kind of upturn in sales and revenue, and I think it's the kind of post-pandemic feeling coming through. I also think the kind of cost of living crisis has meant that a lot of travellers are looking to try and potentially get more value for hotels, and certainly the Premier Inn range is more cost effective for anybody looking to go on holiday. So certainly the results were good, strong revenue sales. And I think the one thing that was quite encouraging is the fact that future bookings were also strong. Yeah. And I think you've also seen an increase in revenue from the room rates. One thing I think the statement didn't sort of highlight was any kind of guidance about the potential sale of some of the Beefeater or Brewers Fayre sort of restaurant chain, which I think there was potentially going to be some kind of story that we might get some announcement, but there was nothing in today's statement about that. So I think that's a story that might kind of rumble on.
It seems to me they're almost ashamed of that business because they don't even mention it in the statement. Yeah. They just talk about food and drink sales, which will, of course, include a portion of Premier Inn as well. I mean, it's most peculiar. It
is, because the actual food and sales kind of were up 10%, so it was a decent sort of strong return from the business, but it doesn't seem to ever really get much, as you say, kind of coverage, and it seems to be the kind of the secondary part of the business, but it still seems to deliver some to the numbers. So I think it's something that if they do, they're talking about getting rid of 250 of the part of the restaurant chain. So, and I think expansion in Germany still seems to be the main focus. Yeah. So they obviously see that as their growth part of their business.
Very much so. Now, DS Smith, I mean, it was fascinating. Early in the year, a lot of CEOs that I spoke to, they would always, I'd ask them, are you able to pass on your costs to customers? Are people sucking it up? And the answer was almost overwhelmingly yes. And I mean, DS Smith, great example of that today. Yeah,
I think it has been. We've seen really strong profits, really strong revenue numbers. I think the one thing the market was probably looking for was an increase in sales and their volume numbers, which hasn't come through. And I think it potentially highlights that they maybe see second half of the year, I think maybe reflective of what's happening in the broader economy, and whether we actually see certainly packaging, which is their main business, being impacted on a slowdown in economic activity, although they are predominantly suppliers of packaging for sort of consumer staples. So you would think that's going to have less of an impact if we do see consumers spending a bit less or some trade kind of reducing over the year.
Yeah, it's difficult to call because it is quite a sort of consumer-geared stock, isn't it?
Yeah, it is. But I mean, there's healthy numbers and the dividend again's increased. So I think there's potentially quite a lot to like for holders of the shares from today's statement. I think if they can start getting their volume numbers up a bit, then I think we might see a bit more appreciation in the share price, because it has lagged a bit this year and it hasn't had any real kind of momentum. It's been down nearly 10% since the start of the year.
Yeah, which is fascinating, because I mean, it wasn't that long ago since we were all talking about potential consolidation in that sector. That appears to have gone away a bit.
It has. In today's announcement, there was no kind of further chat on that, and there had been some sort of talk, as you say, of consolidation in the sector, but nothing new there.
So what about the Bank of England then? Are you expecting a quarter point or a half point today?
I think if you'd asked me up until yesterday morning, I think it was quarter point was what everyone anticipated. And now I think half a percentage point, could be up for grabs. And I think the market, there's a kind of 50-50 now split. I think yesterday's inflation numbers are going to be worrying for the Bank of England, because we saw, I think, entertainment, travel being the big thing. So it's really consumer spending that's driven the numbers. We know mortgage rates are going up, but people still seem to have more money in their pocket, and a lot of people in fixed term rates haven't felt the pinch in this. So from the Bank of England's perspective, it's whether or not they decide to go fast and hard today and sort of maybe make a bit of a statement, or whether the rhetoric is still being 25 basis points, but I think it could be anything up for grabs. And as the day goes on, I think it'll be, or even get near to lunchtime, I think half a percentage point may come through.
Yeah, we don't have long to wait.
No.
So good to see you. Thank you.
Thank you.
Time now for a look at this morning's business pages, and the Financial Times splashes the front page of its print edition with yesterday's higher than expected May inflation figures in the UK. Inflation obviously coming in at the headline rate of 8.7%. That was unchanged from April. The market was looking for 8.4%. Well, the FT carries analysis on its third page by its economics editor, Chris Giles. He writes that economists are now expecting bank rates to rise by 5% to 5% or 5.25% by mid-summer. Well, the FT also reports on its front page that the US Federal Trade Commission has sued Amazon, accusing it of duping customers into signing up for its Prime service without their consent and sabotaging efforts to undo their subscriptions. Well, the Times leads its business pages with interest rates. It also reports on its business front page that the fashion designer Christopher Kane's company is teetering on the brink of collapse after the pandemic pushed it into the red. Well, that story also makes the front of the Daily Telegraph business section, but the paper leads with news yesterday that the UK's debt to GDP ratio has risen above 100% for the first time since March 1961. Now, if you've ever been to a major rock concert in Australia or New Zealand, or bought a record or a piece of merchandise there, the chances are that some of your money ended up with Mushroom Group. Australia's largest independent music and entertainment company not only puts on concerts, it also publishes and produces music, represents artists and writers, and it makes music videos and documentaries. Well, the company, which helped make Kylie Minogue and Jason Donovan into household names and big recording stars, turns 50 this year. And joining me now is Matt Gadinsky. He's the Chief Executive of Mushroom Group. Matt, great to see you this morning. I mean, traditionally, music companies only put out the records and things like concert promotion, looking after the artists and all the rest of it. Well, that was done elsewhere. You've been doing that for a long, long time now, and it's almost become the industry model.
Yeah, when my dad founded the company in the early 70s, he was really all about trying to work our artists in every facet of the industry. And at that time, it was very much a foreign concept. And fast forward 50 years, it's sort of the way that a lot of the industry survives. So some would say we were ahead of our time with the model, and it's what has us sitting here 50 years later. It's not many music companies survive 50 years.
Yeah, I mean, how did that model evolve, though? That was just something that your dad sort of twigged, was something that a lot of artists quite liked, was it?
At the time when Mushroom started, the Australian music scene was not really existent. It was just getting on its feet. There was not much original music out there, and it was really the only way it was sustainable, and probably the only way that kept Mushroom on its feet in the first 10 years. And since then, not all artists like it, but it's, like I said, what has us sitting here on our 50th anniversary.
So tell me, how Australian music became I mean, it is a powerhouse now. I mean, Australia does punch above its weight in global music.
Well, definitely over the last 10 years, as the streaming era has really taken over, music's more accessible globally, and we've seen more Australian artists than ever before have success on a global scale. We've been responsible for, successful careers with artists such as Kylie Minogue and Vance Joy and many other great exports. But at the moment, there's more Australian artists than ever that are having success on a global scale.
Why do you think Aussie music travels well?
I think it depends, not to all markets, but Australia and the UK have a lot of similarities, and it feels that a lot of our music connects here. We have a fantastic artist at the moment, the DMAs. This is their biggest market. They're from Sydney, but globally, this is their biggest market, and it just seems to work.
I mean, your dad, when he set up the business, and since, he's just worked with so many amazing people over the years.
Yeah, well, usually, as you said at the start, any artist that comes into Australia usually has some touch point to the Mushroom Group, whether it be through recorded music, publishing of music, touring their live concerts or merchandise. We've usually got some involvement with every artist, so it's a model that's worked, and one that we hope can survive for the next 50 years.
I mean, a lot of musicians have quite big egos, particularly the sort of stars of yesterday. Are the current crop easier to work with?
I think it's not easy putting yourself out there and putting your own songs out there. So I think, look, we've got a very artist-friendly company and have great relationships with artists. So it just comes with the territory, I think.
Very diplomatically put. Now, what about the live music sector in Australia? Obviously, COVID lockdowns in Australia were very, very tough. Is the industry getting back on its feet now?
Yeah, it was a really tough 2 years in Australia, across the globe, but especially in Australia, the entire live music scene was turned on its head. And just coming out of our first post-COVID summer, it's probably one of the biggest and most successful for the industry as a whole. So a lot of economic challenges, ahead. But the way that it's recovered over the past 12 months and bounced back is stronger than any of us could have anticipated, I think.
Now, you've got a big concert coming up in Melbourne to celebrate your 50th anniversary of the business. Are you naming names yet? Who's performing?
No, it's still very much early days, but in November we'll be hosting a concert to celebrate the 50th anniversary. We had a concert for our 25th anniversary in the late 90s at the famous MCG, which at the time was the biggest attended music concert in Australian history. So we're not quite going to replicate that, but we're going to deliver something very special for all the people that have been connected to Mushroom and supported Mushroom artists over the journey.
Right, but so this concert, is it going to be at the G?
I can't say exactly where it's going to be yet, but we'll see if there's not a cricket match on there.
Very good. Matt, good to see you this morning. Thank you.
Thank you.
Now, the confectionery brand Tony's Chocolonely has secured an additional €20 million worth of funding from its existing shareholders, with the aim of stepping up growth in a number of markets around the world. The money raised will also go towards supporting the rollout of Tony's Open Chain, the company's global business-to-business ethical bean trading company. Well, joining me now is Douglas Lamont, who's Chief Executive of Tony's Chocolonely. Douglas, good to see you this morning.
Thank you, Ian. Thanks for having me on and talking about the progress.
Very good, yeah. Now, which are the markets that you're targeting for growth?
So obviously we're a Dutch company by background, and so we're sort of number one bar brand in the Netherlands. But what we're really focusing on now is also growing in other markets like the UK, in Germany, and in the US. We've seen great growth in those markets in recent years, and it's about how we build on that and consolidate that. But actually, you were just talking about Australia. We're seeing great growth around the world, and so in many markets, but our focus is those big markets.
You're now the biggest selling brand in the Netherlands, which is an absolutely extraordinary achievement for a relatively young business. Are there any other markets where you're close to achieving that kind of milestone?
No, I mean, we've been operating in the Netherlands as a homegrown brand for the last sort of 15 years. So it's one of those things that takes a little while, but what we are seeing is rapid growth and becoming, a clearly important player in multiple markets. Here in the UK, is a good example where we're now getting 3, 4, 5% market share quite quickly, which means it gives us a great platform to build the company. And let's be clear, our company is about making impact and addressing the issues of exploitation in the cocoa supply chain. And you know, for us, you know, what we're trying to do is raise awareness of the fact that, you know, living income prices are not being paid for cocoa by the majority of people in this industry, which drives many issues like child labour. So you've got 1.5 million children working in child labour in West Africa, and we think that's socially unacceptable. And our whole brand is built around that mission. And so we, as an impact-led first company, you know, yes, the growth is interesting, but ultimately it's driving beans, which drives volume to our model, you know, with a really clear sourcing model on the ground, which we've, you know, built up over the last 10 years, and importantly got the evidence to show that that model of paying living income, addressing child labour really works, when the rest of the industry have sort of acknowledged it 20 years ago and not really done a lot to address it. So yes, growth is interesting, but it serves the purpose of our mission to end exploitation in the whole of the cocoa industry.
And you're looking to grow out Tony's Open Chain as part of this fundraising. What will that entail? Is that about bringing in new growers and new suppliers on board, or is it really getting more people to use the business, that use the chain?
Yeah, no, it's really about supporting, you know, as we've got our own teams on the ground in West Africa. You know, Ivory Coast and Ghana are 60% of the world's cocoa sourcing, and so making sure that we've got a robust team delivering on our 5 sourcing principles is what we will invest in. But as you've said, this is about bringing on partners, and recently Ben & Jerry's effectively committed to Tony's Open Chain. So for a big company like Ben & Jerry's, who are already sourcing on the ground in West Africa, seeing the challenges of you know, it is a difficult environment, they came and saw what we did, and they've now committed their global cocoa sourcing to Tony's Open Chain. I think that's a huge endorsement of what we're doing on the ground. So yes, it's about bringing in more and more players from the chocolate industry, but for, you know, many companies use chocolate in their supply chain. So, you know, we're open for business. We open source everything. This is about changing the industry, not keeping things for ourselves. We want to be an open source company that anybody, even one of our competitors, you know, can source our beans. And we have one of our competitors in Germany using Tony's Open Chain beans, because this is about collaborating and working together to change things on the ground to improve lives, you know, for farmers in West Africa.
Now, the last time we had you on the programme, you were Chief Executive of Innocent Drinks. And of course, the Innocent founders are among the shareholders of Tony's. What was behind the move?
So look, the thing that gets me out of bed in the morning is proving that good business can be big business, and showing that you know, a new model for how you successfully operate companies of balancing people and profit and planet. You know, we need to keep proving those examples. I think Innocent was a great example where we scaled it to become Europe's #1 over 500 million turnover and a successful company, but being purpose-led. And I think Tony's is another great example where you can take a business and scale it globally. And, you know, we've got great ambitions, but because it drives impact and showing that you can run a successful, profitable company, but whilst being really clear about your balance between how you make profit, but you do that really focus on your externalities of your people throughout your supply chain and the planet as well, because deforestation is clearly a big issue in West Africa as well that we're very focused on.
OK, Douglas, we have to leave it there. It's good to see you again this morning. Thank you.
Thank you for having me on.
Now, it's referred to in the logistics industry as the last mile, the final step of the delivery process from a distribution centre to the end customer. Well, to achieve that, you need warehouse units, often on the edge of a town or city, within an hour's drive or so of the delivery address. Well, those are just the kind of assets owned by the property investment company Urban Logistics REIT, whose tenants include the likes of Amazon, DHL, Hermes and Royal Mail. Today, it reported net rental income of £53 million for the year to the end of March. That was up 45% on the previous 12 months. Joining me now is Richard Moffat. He's Chief Executive of Urban Logistics REIT. Richard, welcome to you. I'm clearly looking at that rental uplift. There is plenty of demand out there.
Yeah, good morning, Ian. Thanks very much for having me on. We are pleased with our results this morning, despite the testing conditions that face us. But yes, you're absolutely right. We can see a clear line of sight to around £10 million of rental uplift, given units that we have to let in our portfolio, units we have let post-period end, and indeed the rent reviews that we're facing in the next 12 months or so. So yeah, demand remains very high, with a UK vacancy rate of only 5%, which is, I think, the second lowest vacancy rate I've seen in my 30-year career.
Which is extraordinary. I mean, what's been happening to letting activity within the period? Are these new tenants coming on board, or are these existing ones rolling over their deals and you getting an uplift in the process?
Well, I think in terms of the growth in online, everybody gets very fixated about fashion retail. We actually don't have any fashion retailers in our portfolio because we try and eschew volatility. And my 30 years has demonstrated that things like fashion, they do what we all expect them to do, which is to go in and out of favor. And we focus on essential goods. And what we are playing to really is all of this supply chain sophistication that is going on currently, where large corporates need to move goods around the country and then finally into your home or your business. And it's not just about fashion, it's about food, it's about pharmaceuticals, it's about widgets, it's about fishing tackle, you name it. Anything you can get on the internet these days needs to be moved into a last mile distribution hub.
Now, the loan to value ratio on your portfolio is 29%. I mean, that's pretty conservative. You've got plenty of scope for gearing up if you wanted to.
Yes, I think at the year end we had liquidity of around £30 million of available cash. We have a very low LTV at 29%, and our debt is very secure. We've got 85% of it at a total all-in cost of 3.4%, and with about 5.5 years to maturity. So we feel we are in a good position. We could leverage up further if we wanted to, but I think it's a time to progress cautiously and probably to recycle some of our longer dated income, our longer let assets into assets where we can do more asset management, which is our particular strength.
A lot of commercial property companies are having to spend heavily now to improve the EPC ratings of their portfolios. Is that high on your agenda?
Yeah, very much so. I mean, we're very fortunate, and I could never have foreseen this when we IPO'd in 2016, because ESG just wasn't at the top of anyone's agenda at that point. But the reality is, over the past 2 years in particular, we've made huge strides in terms of the transparency of our reporting. Our EPC ratings have gone from 22%, I think, to about 55% in the AB category. So it's a real focus for us, but we're very lucky that the type of tenants we have are typically large corporates like the NHS, J. Sainsbury, Travis Perkins, and so on, to whom the whole ESG agenda is hugely significant. And they tend to spend their money on our buildings. And of course, we will spend money where we're asked to or as part of a commercial deal. But it's a very, very different scenario from your average multi-let industrial estate up and down the land where tenants will be asking the landlord to commit.
Richard, are you seeing much geographic variance in how parts of the business are trading?
I think we're certainly seeing now geographic variance around supply and demand. And I think there are certain markets now where there is a degree of supply coming through. But fundamentally, we focus on the top 20 UK urban centres and the main arterial routes around the UK. And that's where there is, by and large, the greatest undersupply and where we can find units that are going to give us the greatest rental growth.
OK, Richard, we have to leave it there, I'm afraid. Good to talk to you this morning. Thank you.
Thanks very much.
And once upon a time, companies managed their own pension schemes, but growing complexity, more legislation and the need for specialist expertise led to the creation of the pensions consultancy sector. The market tends to be dominated by big global players like Willis Towers Watson and Mercer, but the largest pure pensions consultancy in the UK is XPS Pensions. Today, it reported a pre-tax profit of £19.1 million for the year to the end of March. That was up 13% on the previous 12 months. Joining me now is Paul Cuff. He's co-chief executive of XPS. Paul, good to see you this morning. What's been driving demand over the last 12 months for you?
Essentially, our clients have needed a huge amount of support against a backdrop of a huge amount of turmoil in financial markets. And of course, we've seen really quite dramatic changes in long-term interest rates. We've seen dramatic changes in inflation, and these have quite profound impacts on pension schemes. And I'm very, very proud of how well we've looked after our clients in what's been an extremely busy time for them.
Yeah, you mentioned, the tumultuous events in the autumn last year with the LDI situation. What's the general sentiment among clients right now?
Most of our clients actually are in a better financial position than they were. Rising long-term interest rates tend to produce improvements in schemes' financial positions. Their long-dated liabilities are measured using long-term interest rates, and when those go up, the value of the liabilities comes down. And generally, our clients are in a better place than probably they realistically would have expected to have been 12 months ago. But at the same time, then there's quite significant challenges that when they're in a different place to where they expected to be, how should they protect themselves, lock in the gains that they've got? And of course, there's also the very real problem that high inflation actually potentially also erodes the value of some of the pensions that people have built up over the years. And so that's another challenge for them to deal with as well.
As you say, rising interest rates generally tend to be good for scheme deficits. Are you surprised we haven't seen more bulk annuity deals as a result of that?
Well, the bulk annuity market is very lively and volumes are rising. I mean, there's about £1.5 trillion worth of liabilities in the UK defined benefit sector, in the private sector alone, which is a fairly eye-watering number. Deal volumes for bulk annuities are on the rise, but they're probably still only likely to touch about 50 billion this year. 80% or so of schemes still aren't actually in a position to be able to execute such a transaction. I think what's really interesting is for the 20% or so that might now be able to, that's a very significant increase on recent years. For them, the optionality about what to do and whether actually they might use some of the surpluses they've got in their pension schemes to support them, in times of wider challenges for the employers and for the members. And there's now a lot of different optionality that's available that, again, 12 months ago perhaps was a bit of a distant dream.
Yeah, now one of the other big talking points in the industry right now is this idea that's been floated by the Lord Mayor of London and Rachel Reeves, the Shadow Chancellor, a future growth fund in which some pension funds would be compelled to invest. What's your thinking on that?
I think there is a lot of merit in thinking that the vast quantity of assets that exist in UK pension schemes in the defined benefit space, but also increasingly in the defined contribution space, could be used as a great force for good. And we are quite vocal about this, particularly now pension scheme funding levels have improved materially. And I think we've got to get the balance right here. We've spent 10 years, 20 years really fixing quite a fundamental problem, and pension schemes are now generally in a much better place than they were. And yes, many of them have now moved into a position of surplus and so on. Accessing that surplus to drive growth in the UK economy, to address a second fundamental problem of tightness in the labour market, and actually to address the third big problem that the UK has, which is the long-term savings gap, that we're talking about these defined benefit schemes being well funded, but for generations coming through, the money that's going into their pension schemes in defined contribution probably isn't adequate for their long-term future. And I know talking about increasing savings at a time of a cost of living crisis might sound quite hard, but there is a great opportunity, we think, from the improvement in the financial position of these big schemes to address some of those fairly systemic problems, embedded problems that the UK has. So, supportive of the principles, there are many interesting ideas out there. There's a really healthy debate about how best to do all this.
What about this notion of being compelled to invest a proportion of funds?
I'm not supportive of that. I think each individual pension scheme has genuinely unique circumstances, but I do believe if you tweak a few things, and they don't need to be huge changes to the system, that create incentives to invest in longer term growth, where those taking the risk can benefit from the reward of doing so, I think that would drive quite a significant shift in and of itself. So I don't think wholesale change is necessary to achieve the objectives that are being set out here.
Yeah, I mean, you touched on this a moment ago. There's a lot of talk in the air right now of consolidation of defined contribution funds. What are the obstacles to that happening?
We're seeing quite a lot of that already. It makes quite a lot of sense. Master trust arrangements, which are bundled vehicles, are taking on a lot of single trusts, and so you are seeing consolidation. Why do you do that? You get much better value for money, you get more purchasing power, you get economies of scale. At XPS, we have a master trust. It's one of a number in the market, but certainly that's an area that we expect to see some good growth into the future. The obstacles, it's a lot of hard work to do it. There are some regulatory hurdles that could be made a little bit easier if you wanted to achieve this. And I I think direction of travel, that's where the industry is likely to go.
Yeah, do you worry about the competitive landscape? I mean, NatWest, for example, have just bought Cushion, which owns a master trust business. I mean, clearly they're flexing their muscles and about to move into that patch.
Yes. The master trust space will consolidate. I think the future is that there's over 30 master trusts at the moment. Potentially there'll be 10 plus or so in the reasonably near future. I can't crystal ball gaze, but I think that's the direction of travel. At XPS with National Pension Trust Hours, we're determined to look for partnerships that will help us on that journey and ultimately to continue to play an active role as the market does do that.
All right, Paul, we're out of time. Busy day for your results day. Do appreciate you sparing the time.
Thanks very much.
Thank you.
Thanks.
That's it from me for today. There's much more on the Sky News mobile app and on the website with reporting, video content and analysis from our business team. You can have a read of that piece that I mentioned earlier on in the programme by me up there right now. I'm back at 10 o'clock tomorrow morning, but I'm also up on the TV channel throughout the rest of the day as we digest what is likely to be another interest rate rise from the Bank of England at midday today. Thanks very much for joining me. Cheerio.